Good afternoon and welcome to CNBC Africa's special broadcast of Nigeria's first Monetary Policy Committee meeting of the year. I am Wole Famirewa. In a few minutes, we will be crossing over to Abuja to listen to Nigeria's Central Bank Governor Godwin Emefiele as he reads the considerations and decisions of the MPC members. This meeting is coming up against the backdrop of rising inflation, continued fluctuations in global oil prices, and of course the upcoming general elections here in Nigeria. But before we cross to Abuja to hear from the CBN governor, joining me in the studio to preview the announcements are Andrew Nervin, partner and chief economist at PwC Nigeria. I also have Abdulrahman Yunusa, governing council member at the Chartered Institute of Bankers of Nigeria. And joining us from Johannesburg is Roy Daniels, head of the Africa Trading Desk at Rand Merchant Bank. Gentlemen, thank you so much for joining us. Abdulrahman, I'll start with you. Maybe you just give us your perspective on the key considerations at this meeting. I think the consensus view is that there will be no change, but what are your thoughts here?
Yes, I will subscribe to that consensus view, not because it's the right thing to do, but because it's what is expedient, because there is an election on the horizon. And we do know that political consideration will always play a big role in whatever it is that is being done. So maybe the idea is to hold and see how things pan out. But if you ask me, the economy has been suffering from a lot of lack of impetus, lack of action. And one would have thought that having held in the last two meetings, all on the same excuse of, we don't know what election is going to be, then here we are still going ahead to hold again for another term. So I think we should, yes, expect them to hold, but I think maybe they will surprise us with something on the positive side.
Obviously, it will be a huge surprise if they do make any changes. Andrew, your perspective, and there's no doubt that there will be a big focus on the economy and growth. The IMF earlier was revising its growth outlook for Nigeria, so clearly there is a lot of concern around growth. But Andrew, your perspective on the big decisions that need to be made today.
Well, the IMF cut the growth forecast overnight, in effect, and kind of feeding into the MPC meeting. So there's a lot of pressure to get the economy going faster. Growth now projected at 2% by the IMF, well below our population growth rate. On the other hand, we have so many headwinds externally. I mean, there's a pause in the U.S. rate rise. We'll see how long that lasts. But with oil price shrinking so much, it also puts tremendous pressure on the system. So I think we're entering a very volatile phase for our economy. I expect the MPC will probably just sit tight for exactly as we come into the election. Not an easy situation for the economy.
Roy, you obviously would share the perspective of foreign investors here. And it's certainly an interesting time for foreign investors. You have to certainly consider the elections and the impact of that as you assess the risk of investing in Nigeria. But clearly over the last few days, we have seen a flurry of investment into Nigeria's fixed income markets that suggests that some foreign investors are beginning to look this way again, quite a bit entering the market, chasing those yields that are as high as 17.6% for the one-year T-bill. Your perspective on what this meeting could mean for your investment decisions moving forward?
I think firstly we would go along with the consensus of no move in the rates. I think they're going to come out unchanged. Looking at the foreign investment into Nigeria, we sort of the back end of 2018, we saw quite a fair amount of disinvestment, some money going out, and I think those are just some of the nervousness around some of the investors ahead of the election. So looking forward and looking at the election, I mean, there's a lot of talk about the election, a lot of concerns about, could it be a little bit wild? Could things go wrong? We don't subscribe to that, and our view would be peaceful elections. No major changes. And I think some of those investors are looking at the Nigerian market. We've seen a good recovery in emerging markets. A lot of investment returned into emerging markets early January, and Nigeria has been lagging a little bit behind. I think people are looking at the yields now and trying to see beyond the elections and find the yields now rewarding enough to come back into the market. So we've seen a bit of investment returning cautiously, not as much as we saw going out, but I think they're cautious investors now, afraid that post-elections, they would then miss out on these good yields. So we anticipate that to continue.
Abdulrahman, clearly if you're an investor, these are great times if you're investing in fixed income instruments. As I mentioned, 17.6% yield on the 1-year T-bill is clearly remarkable. So local or foreign, you certainly like that. But we certainly have to focus now on growth. because there are a lot of negatives when you think about banks not really being liquid right now. I'm hearing that we're seeing some form of stabilization, if you like, securities being implemented again, which essentially are robbing the banks of whatever small liquidity they have. And then, of course, the banks are not really motivated to lend, given this high yield environment. Your perspective on what this continued high interest rate environment could mean for the economy that really needs to get going?
Well, I think the truth of the matter is that once the CBN starts to use the stabilization securities, or whatever name it is called, I think it's getting into desperation mode. Maybe
to protect the currency.
Maybe they are anticipating that there will be a lot of election spending. There's also the challenge that will come with the minimum wage increase that will come down the line. So it's possible maybe they are actually anticipating things and beginning to take some preemptive action. But clearly, I mean, rates at 17% and above is not healthy for the private sector to borrow and grow. We also know that a lot of foreign investors, especially in the U.S. area, remember there has been 2 or 3 increases in rates in the U.S. In recent times. So that, again, has shifted attention and funding into that area. So I think what we need to do is to actually begin to fund our own economy here and not, get carried away with the election issues and the funding issue. Because for me, if exchange rate is a challenge, then you should deal with it and not stifle the growth of the economy itself, because unemployment is a challenge. And we do know that with youth unemployment, there are issues of security and issue, of violence.
Right. But Andrew, wouldn't you say that inflation also is a big concern right now? Because December numbers point to higher numbers, 11.44% in December, food inflation at 13.56%. And with the prospect of a new minimum wage and the inflationary impact of that, your thoughts on the case to continue to tighten moving forward?
Well, we said about 18 or 24 months ago that we had a window of opportunity with oil prices a little bit higher, 60s and 70s, to kind of make progress on our diversification, make progress in coming back to growth. I think where we're at today, that window was not used effectively, was wasted in effect.
So you think we should have eased at some
point? Well, now we're back to
now.
50. Well, we should have grown faster, whatever it took to grow faster. I mean, the reality is the central bank policies are only one dimension of growing faster. The structural policies from the federal government and others are more important than what the central bank does. But we've squandered that opportunity because now we've come out of the $70 oil, $50 oil. It could go lower. We're still only at 2% growth. We've got a big budget deficit. The we've talked a lot about government borrowing crowding out private investment. And one of the things we've said, you have to get tax receipts up, but it's very difficult to ask for more tax dollars or tax naira when the economy is not growing. So we've kind of got into this very difficult spot right now. Coming into the election, people are going to kind of put their hands up. I mean, as Roy said, the last month we've seen, or last 3 weeks post-Christmas, we've seen an improvement in sentiment in emerging markets, but it doesn't counteract what happened in all of 2018. And if you take the example of Turkey, they had a very difficult time, current account deficit, borrowing in dollars. We were insulated in that period because the oil price was very high, but now that insulation has gone away, and I just think we're in a very difficult spot coming into the election. But the MPC is going to probably just sit and say, no reason to move right now.
Let's speak to the foreign investor. Roy, how are you viewing the Nigerian economy right now, given the prospects for the oil price moving forward and what the IMF is telling us about the growth prospects in the context of the fragility of this economy? We know the big issues around weak infrastructure and so forth. How are you thinking about the economy?
So I think Andrew makes a good point, that Nigeria was fairly sanitized against the EM weakness that we saw, through all emerging markets, and South Africa wasn't untouched in that as well. I think that sort of sanitization by the oil price. So the key, we're looking at sort of key indicators as to what we're doing, one of which is the oil price, one of which is the reserves. We've seen the reserves, the FX reserves dip a little bit, but we allow for that with that bit of disinvestment we saw over December. We anticipate that reserves will now start growing again. Oil price, we're keeping an eye on it. As far as investment and economy-wise, and where would we look as foreign investors, and certainly from our large sort of offshore base out of London and Europe into Nigeria, certainly looking at those yields, as you say. I mean, we can't ignore what the yields offer to the non-resident investor. And again, in addition to that, the liquidity that Nigerian market offers in comparison to some other emerging markets where liquidity is very tight, so you can get in, but it's very difficult to get out. We find that as long as you conform to the exchange control regulations in Nigeria, the ease of disinvesting is possible, as we see in South Africa. So you can suffer a little bit under that, puts a bit of pressure on the currency. The currency is stable, slightly firmer. If I look at the signs for a non-resident investor into sub-Saharan Africa, I think Nigeria offers the liquidity, it offers the yield, it offers the opportunity. So I think it's good times. Again, we don't anticipate any change to the MPC rate. So I think from the MPC committee, and if anything, it's a kind of decision time now. Do we see food inflation calming down? Do we see inflation tracking? Do we see a slightly higher oil price? I think there's early promising signs on the horizon for Nigeria, and we kind of anticipate from the First Rand Group and from RMB that we might see a slight easing in inflation, a rate cut potentially, not until probably, if things are going well, until Q3, Q4 2019. So we'll keep an eye on those key lead indicators for us, and again, look for those opportunities for those offshore investors.
All right, but Roy, let me test your conviction around the Nigerian economy right now. So if we had a scenario where oil were to slip to below 50 and perhaps stay there for a couple of weeks, would you still be as confident bringing money to Nigeria? Do you get a sense that that sentiment could change?
Okay, so now comes the point at which you're on the spot. So there's a couple of things to be watching at the same time, Wally. One is the oil price, budget price, the reserve pricing, and the exchange rate, kind of the three things we would be watching. Exchange rate, we're happy with. Oil price, just above $60 a barrel. We'd like to see it probably upper end of 60s, low 70s. I think it's working well there. Should it dip below the $50 a barrel, we would then look to the MPC, to the government, to the central bank to say, well, due to the low oil price, these are some of the cost cuttings that we want to introduce. This is where we're going to reduce some of our expenses. So those are the key things. Oil price is great, but a low oil price means we've got to have some sort of cut in spending. If we see those sort of announcements, then the conviction to invest remains in place.
All right. Okay, let me hear your perspective on what perhaps would follow the delivering of the communique by the CBN governor. That is the Q&A session. And I do imagine that we could see some journalists asking questions around the differentiated CRR policy, to what extent that has worked, because this is one announcement that was made a couple of MPC meetings ago. So your perspective on that, because what I'm hearing is that it's not necessarily, we're not seeing banks running over each other to get to the central bank to take advantage of this. So do you get the sense that that is one policy that's really dead on arrival, given the peculiarities of Nigeria's economy?
Yeah, what I would say up front is that instead of doing the T-bill sale to banks without consultation, that should have actually been used as a window to motivate and make sure that you have this corridor that allows you to rediscount and then to access the market without having to have it done by fiat. But I know the challenge has always been exchange rate. And I do know that there's already talk about that 41 list of commodities, that cannot access the FX market. Probably will go, I think one was added earlier.
Yes, fertilizers was added late last year, yes.
But there's also the talk, I think there was something quoted from the central bank governor that it may be
He did make a comment recently suggesting that we could see another 8
yes, being added to take it to 50. I think import substitution, as late as it is in the day, is actually what is going to save the day. Because recall that with the refinery of Dangote, if it comes on stream in 2020, almost 1/3 of the FX requirement will just be wiped out.
Right.
Okay. Now, if you're able to do another 200% in terms of export of those petrochemical commodities, then it's like actually increasing our FX income by about a factor of 150% just by that activity alone, because you're going to reduce demand and you're going to increase supply of that commodity. So I think for me, the idea is to make sure you get the economy working and get import substitution so that people can be able to find commodities that will replace what we are importing. That is the magic wand.
All right. Let me ask Andrew, still on that point about this list of items that are banned, that the central bank is not willing to sell FX to importers of. Would you agree that that is the way to go? Because now there is a suggestion that we could see more items added to that list. Is that really a practical solution that reflects the reality of Nigeria right now?
Well, I think we've been very clear over the last 18 months that, as the ERGP said, we should be moving to market-determined exchange rates. That we understand the arguments to drive import substitution by banning these items, but the truth is the ban is really not effective. I mean, sometimes products are intermediary products. You stop people producing here because they can't import one item. Sometimes we delude ourselves, like with the rice imports, where we say there's no rice imports, but we know that rice is coming in through the Benin border. So we don't think it's very effective. And the reality at the end of the day is we're only going to have a strong Naira if people want the Naira. And are we ever going to have people going to want the Naira if we make it difficult to go in and out? I mean, one of the things we've talked about many times is we know we need foreign investment. We need a significant amount. I mean, it's 15 trillion Naira a year. We need it in portfolio investment, and we also need it in direct investment. When outsiders are confused about the exchange regime or they have any doubt they can go in and out, they're not going to invest, and we've seen that. So in some sense, while I understand the CBN's efforts with the 41, 42, and the 50 items, I think that they've won the battle but lost the war.
All right. Okay, let me go back to Roy and just get your perspective on the exchange rate and how that feeds into your investment decisions as a foreign investor. A few months ago, there was an argument that foreign investors were looking to the central bank to allow the currency to depreciate before they bring their dollars into the country. But I've been speaking to some traders and salespeople recently, and they're saying that the evidence right now is that those same foreign investors are certainly not looking that way. They are more willing today to bring in their dollars. Can I get your perspective on this?
You see, when we look at the exchange rate, and if there's a fear of a devaluation of the exchange rate or a sudden move and it suddenly weakens, then the foreign investor is going to wait for that opportunity for the currency to weaken. So the question is, do we foresee any sort of short-term weakness in the Naira? Do we expect it to blow out to above 400? Now, listening to what Andrew is saying there around those import products and the ban on this and trying to protect the currency and the changes, and those are the sort of dialogues that make foreign investors nervous. When there's an uncertainty about what will a central bank do next to impact on the exchange rate. I believe that the banned item story is now well diluted into the market and into the exchange rate. The foreign investor is looking at a very stable Naira and a high yield. So those are the ideal investment opportunities. Nice stable currency, pick up a nice carry of like you say, 17% for the year. Currency doesn't devalue, great return. If we got a yield of 17% and we suddenly see a blowout in the Naira by 7 or 8%, then that's when we're going to see a lot of nervousness. So when I look at the picture right now and the one in front of us, it is a good foreign investment opportunity now. I believe that rates are good, currency is stable. But if we tweak and we mess and we change things too much and we create uncertainty around the currency, is when we'll see a negative sentiment from the offshore investor. So the immediate picture, good one.
What is the feeling right now?
Right now, the feeling
Sorry to cut in. I just wanted to confirm. Yeah. What is the feeling right now? Are you happy with where the exchange rate is and you're willing to do business with Nigeria?
Absolutely. The exchange rate is stable. The yields are good. As I said, the scenario right now is a positive one. Now's the time to get in, but we're keeping an eye on certain flags.
Right, absolutely. Now let's talk about the impact of the elections on all the considerations here. So there's this talk about election spending, and you alluded to that earlier, where you're making the point as to why perhaps we're seeing the introduction of what we could describe as stabilization securities. To what extent, beyond liquidity, do you think it has a bearing on what the MPC decides today?
I think elections anywhere in the world is the unknown factor, is the X factor. So that is the issue whether the current government is going to continue, whether a new government is going to come in, and therefore the central bank will be trying to read the body language of the politics and see whether, okay, maybe they should just hold things, and whoever comes in, they will then try and, identify with whatever political and economic direction that they're going to get. So at this point, they're actually trying to read the political landscape, and I'm sure it's always a mystery whether it's going to get it right or get it wrong. But fundamentally, it's just safety.
Right, but maybe Andrea can ask you this question. Does the elections impact exchange rate policy? Does it make them a lot more cautious in terms of what they do right now?
Does it make the foreign investors cautious?
No,
or
the
domestic?
MPC. I mean, the MPC. Does it influence how they're approaching for exchange rate policy right now?
Well, in theory, the MPC is meant to be independent, and the CBN is meant to be independent.
But
and,
yes,
but,
no
but
doubt.
All,
but
we're all in Nigeria doing this together. So,
but the point I'm making is that elections clearly sort of elevates risks, and so that could impact how they view how they should deal with the exchange rate right now. So I'm just asking your thoughts on whether or not we could see that manifest in today's
Yeah, no,
meeting.
I think if you were sitting in the MPC having the debate and you're looking at the economic data, we've discussed the weakness here, there's some volatility outside, the election coming up. I mean, the optimal strategy is probably just to sit tight. What's the purpose of a move at this stage? You might as well wait until we have some the next piece of uncertainty. Yeah, another piece of data to which is who wins the election. I think what's encouraging, though, as Roy said, is we've seen in Africa in general, we've moved to more peaceful elections, peaceful transitions of power. I think that, as Roy said, investors are not overly concerned about Nigeria. They want to see the election results, but they're not pulling out of Nigeria. So I think that's a fantastic sign for political maturity for Nigeria, for Africa as a whole. But not a big surprise the MPC would probably choose to sit tight. Of course, we may in 5 minutes be surprised and find out that they've made a move, but there you go.
Indeed.
And just to add to what Andrew has said about politics having an impact, and whether in Nigeria, it actually goes beyond Nigeria. I mean, if you recall a month ago, even Donald Trump, was on record, criticizing the Federal Reserve for actually increasing rates.
Right.
So it's actually it's a political economy.
All right, I hate to interrupt you, but we do actually have to go to Abuja.